Hi, this is Karen Lin. In Chapter 3, we are dealing with the parent company acquiring 100% of subsidiary, and the consolidation occurs after the date of acquisition. Let's use a case from textbook page 88. The parent paid $800,000 to purchase 100% of the subsidiary, and the subsidiary has some assets and liabilities that are different from the book values. The fair value are different from the book values. This is the allocation table. The consideration transfer was $800,000. It was allocated to the $600,000 of book value, including common stock, additional paid in, and the retained earnings 1/1, where the acquisition happens. And the $200,000 was the excess that's paid by the parent, and it was allocated to different assets and liabilities. The remaining value that are not allocated are attributed to the goodwill. So we can see these numbers, for example, the trademarks, the allocation coming from the difference between the book value and the fair value when the acquisition happens. Next, we can calculate the amortization from the allocation table. We can see that, for example, the trademarks are not amortized because it does not have definite useful life. For patent, it has 10 years useful life, so it was amortized by $13,000 per year. This number is calculated as the difference, the allocation, $130,000 over the 10 years. So every year we amortize $13,000. The same thing with the equipment. The equipment was negative $30,000 over 5 years. So every year amortization was $6,000. Now here, note that the annual amortization we are talking about here are different from what we have learned when we studied intermediate accounting, where amortization means intangible assets depreciating over the useful lives, and amortization here meaning sort of like a write-off of the excess value paid by the parents to acquire the subsidiary. Let's start with the first year at consolidation. We start with the two companies' financial statement at the end of 2014. Remember, 2014 was the first year that the parent acquires the sub and also consolidate with the sub after acquisition. The predicted value here is almost the same as Chapter 2 when we learned acquisition date consolidation. So basically, let's first predict what the consolidation balances would be. The consolidated revenue, for example, would be the parents plus the subsidiaries. Okay. Now, we don't need this column. I'm just going to delete it. So that's the predicted revenue. Cost of goods sold is the same. So it's basically the added of the two. The consolidated amortization expenses should be the two added up together. But we need to consider the amortization of the fair value over excess. Among this table, we are looking for any assets that are intangible assets whose depreciation will be categorized as amortization. So patent is the intangible asset that in intermediate accounting we know that the use of the patent will be accounted for as amortization expenses. I mean the normal book value amortization. So when this particular asset is when I'm saying depreciating, I'm just using normal economic terms, not accounting terms. So accountants differentiate depreciation and amortization very strictly, but economically it's the depreciating of the useful life of the assets. So we are depreciating the assets during the useful life. Every year we are depreciating this asset for $13,000, and the depreciation are accounted for as amortization expenses every year. So the amortization of the excess will be categorized as the amortization expenses too. So here we need to add the amortization of the patent technology, which is 13,000. Now all these numbers are in thousands, so I'm just going to add 13. Okay, and depreciation expenses are the same. It would be the two added up, but it has to be adjusted for the excess value over book amortization too. So if we look at this table, equipment is the kind of asset that will be depreciated over the useful life in accounting terms. So this negative 6,000 will be depreciating through the depreciation expenses. And here, remember it's a negative 6,000, so we want to minus 6,000. Equity in subsidiaries earnings, if you pause here asking yourself, you know the answer would be 0. So there will be no consolidated equity in subs earnings at the end of the date. The net income, again, is calculated. Do not copy the parent's net income, although you know they should be the same. Okay, so if we see they are the same, we feel safe. Okay, now if you look at this consolidated column, I did put in some formulas in here. It's basically the parents plus the sub plus any adjustment in the debit and the credit. Every row has the same formula. The idea is that for all the debit credit side we use a negative number. For all the debit side we use positive number. So we can use the same formula. That is the P plus S plus debit minus credit. Okay, so you can see currently, because we do not have any debit and credits, our consolidated number are different from our predicted numbers. That is because we need to adjust to reach our predicted value. Next, let's move on to consolidated statement of retained earnings. We start with the beginning balance of retained earnings. Here, the predicted beginning balance of retained earnings will be only the parents, because at 1/1/2014 the subsidiary doesn't exist at all. And the net income comes from the above. Dividend, as you know, should only be the parents, because the subsidiaries' dividend are paid to the parents. So it's sort of inter-entity transactions we need to consolidate, eliminate it. The ending balance would be calculated. So now we can see the ending balance is basically the parent. So basically the whole retained earnings statement are sort of the same as the parents. The balance sheet. Basically it should be the parent plus the subsidiary for all the assets and liabilities, but we need to think about the adjustment along the line. For the current assets, there is a specific case here where the book talks about the parent and the subsidiary has some inter-entity loans. So basically the parent or the either direction, it doesn't matter. So basically the parent sort of lends some money to the sub, or the other way around, doesn't matter. So the lender has accounts receivable, and the other side will have accounts payable. So we need to eliminate these two type of things. So in the book, if you look at the information, it would be saying $40,000 of inter-entity loans. So we know that we need to eliminate this inter-entity account receivable and payables, which is 40,000, because it's inter-entity. The consolidated investment, similar as before, should be 0, and trademark would be the parents plus the subsidiary. But if we have differences in fair value, that's 20,000. We need to add the 20,000. Okay, the trademark doesn't amortize at all, so the fair value excess will not be amortized during any year after acquisition. The same will be done to the parent. The parent, we add the parent and a sub, and now if we look at the parent, it has 130,000 fair value excess, but every year we are amortizing 13,000. So this is 2014, 1 year after acquisition, which is 1/1/14. This is December 14. So we need to add the 130, but we need to minus 1 year of the excess amortization. The same happens to the equipment, basically the P plus S, and then plus the fair value difference, which is a negative, which is negative 13, which is negative 30,000. So we need to minus the 30,000, but every year it has $6,000 amortization on the other side. So we need to plus back 6,000. Now, if you look at the net effect for the first year, after the first year, it's P plus S, but only minus 24,000. This means that the overvalued equipment are brought down to its fair value. So the book value is overvalued. The book is overvalued and brought down to the fair value. Goodwill. Now you can see that goodwill doesn't exist on either company's book, but we need to show the goodwill on the consolidated financial statement. If you remember, the goodwill is 80,000, so it's just 80. Okay. Total assets are added up from the above. So it's from here. And so I want to apologize here. I sort of remember the wrong information. There's no inter-entity loans in 2014. It was in 2017. So let me delete this. Everything else remains the same. The consolidated total asset was $3,561,000. $3,561,000. The same. We do the same to the liabilities. We basically add them up. And the common stock, as we discussed in Chapter 2, would be basically the parent's common stock, because as we said, we discussed before, the parent's stockholders are the stockholders of the whole entity, the economic entity that consists of the parents and the sub. So it should be only the parents. Additional paid in the same thing. The retained earnings comes from the above, which is here. So total liability plus stockholders' equity are everything starting from the liability. Now we see the parents and the sub have the same assets and liabilities. Assets equals to liability plus stockholders' equity. So we know we have a pretty good prediction value. Now again, we can see the consolidated column, which is calculated using the P plus S plus any adjustment, are sometimes not equal to our predicted value. But we know from intuition our predicted value should be the correct number. So how can we arrive at the correct numbers? We need to adjust our financial consolidated worksheet to achieve the correct numbers. Again, let's start with the S entry. The S stands for stockholders' equity. It should eliminate the beginning balance of the retained earnings of the subsidiary. The same here. Should be the positive number. I'm just going to type it in, it's easier. So basically it's the subsidiaries number. Yeah, I basically formulate this column, so anything I type in will automatically have a square bracket attached to it. Isn't it great? It's easier. And that's the S entry. Remember, SAID are related to eliminating of the investment account. So the investment basically would be the S entry added up. To be eliminated. So this would be the S entry, that eliminating the beginning balance of retained earnings, common stock, and additional paid-in of the subsidiary. Now we can see the common stock, for example, P plus S minus the debit, because they are all credit side. So it would be the 600,000. Now it's the same as we predicted. If we do not have this, let me show you. The P plus S will be 800. So we do need to eliminate the subsidiaries number to reach to the predicted common stock. So we add them up. That's the investment in the subsidiary. I want to point out here is that the beginning, we are now eliminating the beginning balance of the retained earnings rather than the ending balance just as what we did when we do consolidation at the date of acquisition. Remember in chapter 2, at the date of acquisition, we are eliminating the ending balance of the retained earnings. I don't want to expand the discussion here, but I just want to point out the difference. If you have questions, you're welcome to ask me separately. So that's the S entry. The A entry adjusts the individual assets and liability to make their book value equal to the fair value without up to amortization up to date, with after the amortization up to date. So for example, trademark, right? The trademark should be 820, but if we add the P and S, it's only 800. So that means we need to restore the fair value to the book value. So if you look at here or here, you can see the trademark has the positive 20 as the fair value difference. So let's add 20 to the trademark. Patent, we need to add 130. Now, you will ask me, didn't you just say that it has to be amortized when the time has passed? That's true. But when we do the A entry, this is the rule of the thumb. When we do the A entry, we put in the fair value difference, the fair value excess up to 1/1. So amortized up to 1/1. So 1/1/2014, we just acquired the sub, so it doesn't amortize at that time. So it should be the original 130 at that point. And the equipment, the same. The equipment should be the negative 30,000. So negative 30,000. Okay, that's the A entry. And we also need to restore the goodwill, which is 80,000. Okay, so you can see basically I restored my assets to the fair value, up the unamortized fair value up to 1/1. So if I add all these up, so and remember this is the negative number. So this is my A entry for eliminating the investment account. Now let's do the I entry. The I entry is basically pretty easy. You just have to look for the equity in subsidiaries earnings, and you take the full amount off. Okay, so that is the I entry. D, by looking at the statement, we can see that the dividend paid by the subsidiary was 40,000. We know that we need to debit our investment account for this 40 because it reduces our investment when the dividend was announced. So when we are eliminating our investment, we reverse what we did before. So it has to be a debit from the investment and credit of the dividend. Okay, so if you look at my consolidation right now, it looks pretty much good, because you can see the goodwill is 80 and you can see the dividend is only the parent's dividend and so on. Now let's do, and the investment account goes to 0. You can see that. The final step is to do the E entry. The E entry basically takes the amortization of this particular year, okay, which is 2014, from the whole entity. So we need to take the 13 from the patent, 1,000, and we need to take the -6. So we call this E, okay, from the equipment. Now if we look at these two, the net effect would be 7. So we cannot add them up because they are different. So the 7 comes from the patent, should be the 13 comes from the patent, should be the amortization, and the 6 would be decreasing the depreciation for the equipment. Okay, so we debit the equipment, credit the depreciation. You need to spend some time to think through the logic why it's a different direction. Although mechanically we know it's different from the undervalued assets, but you need to spend some time to think about it. Okay, so first, when I'm checking my debit and credits, I first check the sum of the two to see whether I forget a debit or a credit and didn't make them balanced. Second of all, I check whether my consolidated assets and liabilities are the same as my predicted number. So they are the same, right? You can see the mechanical way works because it mechanically makes our consolidated number the same as our predicted numbers. Let me conclude what are the differences between Chapter 2 and Chapter 3 when consolidation happens at the end of at the date of acquisition and after the acquisition. When at the date of acquisition, the investment account was the cost of the investment. So it's basically, we only need the S and A entries because we only need to eliminate when we pay for the subsidiary, we paid $800,000. So you can imagine in the first date of consolidation, you only need S and A, which is exactly 800,000. Now, when time passed, the investment account are, I can draw an investment account here, just show how it works. So this is our investment account. And we paid $800,000 at the beginning, right? Later, when the subsidiary announced earnings, the parents basically increase the investment account with the subsidiary's net income, so it's $100,000. When the subsidiary paid dividend, which is $40,000, the parents reduce the investment account. And when at the end of the date, the parent also needs to do amortization, so the amortization is $7,000. That will reduce our investment account. So if we take this, we know it would be this plus this minus, right? So this is exactly the same as the investment in the subsidiary, what we saw here. The idea is that this $800,000 are eliminated by the S entry and the A entry. Okay, it is basically the stockholders' equity of the sub and to restore the excess payment because of individual assets. So this is the full 80,000 that the company paid for the subsidiary. Then when time have passed, this is if you do acquisition date consolidation, you only need the S&A. But when time passed, you have the net income, dividend, and amortization that you need to eliminate. So you basically eliminate this guy and this guy. Okay, 100 minus 7, it's 93. You can see it's here. This is basically our I entry. Okay. Okay, I want to make it a specific number so that you know this is eliminated by the one entry, and this is eliminated by our D entry, right? If you think about it, it's here. We debit investment 40. We debit investment 40 just to eliminate this credit side of 40, and this 93 we credit, eliminate the debit side of 93 of the investment. That's why S, A, and I, and D added up would eliminate 853,000 of the investment of 2014. Next, we need to, if we do not, for example, if we do not have this, we will see the pattern would be the P plus S plus the fair value excess, which will be 788,000, and it's a little bit different from the predicted value. It is because our excess is not amortized during 2014, so we use the E entry to amortize the current year amortization. So that makes our consolidated number the same as our predicted number. So we do need an E entry that is I don't want to put it there because I don't want you to be confused. So that's $7,000. Okay, that's for the patent and the equipment. Then this E entry is going on independent of the investment account, so it's not used to eliminate anything from the investment account.